Value-added tax, VAT, is a consumption tax imposed on the value added to goods and services at each stage of production, distribution, and sale. It is commonly used in many countries around the world as a revenue-generating mechanism for governments. Here's an overview of VAT and how to account for VAT transactions. Understanding value-added tax, VAT. VAT is a multi-stage tax levied on the incremental value added to goods and services at each stage of production or distribution. Businesses collect VAT on their sales, output VAT, and pay VAT on their purchases, input VAT, resulting in the net VAT liability owed to the tax authority. Types of VAT transactions. VAT transactions include the sale of goods, provision of services, imports, exports, and intra-community acquisitions within the European Union, EU. Transactions subject to VAT are typically categorized as taxable supplies, standard rated, reduced rated, or zero rated, exempt supplies, or outside the scope of VAT. Registering for VAT. Businesses meeting certain turnover thresholds are required to register for VAT with the relevant tax authority. Upon registration, businesses are issued a VAT registration number and are obligated to charge VAT on their taxable supplies and submit VAT returns to the tax authority at regular intervals. Accounting for output VAT. Businesses add VAT to the selling price of goods and services when invoicing customers. The VAT charged on sales is referred to as output VAT. Output VAT is recorded as a liability on the balance sheet until it is remitted to the tax authority. Accounting for input VAT. Businesses incur VAT on their purchases of goods and services, known as input VAT. Input VAT can generally be recovered by offsetting it against the output VAT charged on sales. The net amount is remitted to the tax authority. VAT returns and reporting. Businesses are required to file periodic VAT returns with the tax authority, typically on a monthly or quarterly basis. VAT returns summarize output VAT collected on sales, input VAT paid on purchases, and the net VAT liability owed to or refundable from the tax authority. VAT treatment for imports and exports. Imports of goods and services are generally subject to VAT at the point of entry into the importing country, with importers responsible for paying the VAT to the customs authorities. Exports of goods and services are typically zero-rated for VAT, meaning that no VAT is charged on the sale, but businesses can still recover input VAT incurred in relation to the export. Compliance and record keeping. Businesses must maintain accurate records of all VAT transactions, including invoices, receipts, and VAT returns, for compliance purposes. Failure to comply with VAT regulations, such as proper invoicing, record keeping, and reporting, may result in penalties or fines imposed by the tax authority. VAT schemes and special rules. Some countries offer VAT schemes or special rules for certain industries or small businesses, such as the flat rate scheme, cash accounting scheme, or annual accounting scheme, to simplify VAT compliance and administration. Seeking professional advice. Given the complexity of VAT regulations and compliance requirements, businesses may benefit from seeking professional advice from tax advisors or accountants to ensure proper accounting for VAT transactions and compliance with VAT laws. By understanding the principles of VAT and following proper accounting procedures for VAT transactions, businesses can effectively manage their VAT obligations, minimize errors, and comply with regulatory requirements imposed by the tax authority.